My name is Laurie Styron. I am the CEO and Executive Director of CharityWatch. We are the only independent charity watchdog organization in the United States, and we rate charities on an A+ to F scale. So please come to CharityWatch.org for more information. So in this video, I'm going to try to keep it somewhat succinct. I'm going to talk to you about 3 ways in which large charities differ from smaller ones. We're often contacted by donors as well as very frequently by journalists who are investigating issues at nonprofits. And some of the nonprofits that I am asked about are very small. So there's a few ways that you have to think about smaller charities differently. First of all, many of them report their financial activities on a cash basis of accounting and not an accrual basis of accounting. You can dig into the weeds more on this on our website at CharityWatch.org. We have a blog post about it that provides more detail, including lines on the tax filing that you can look at to try to understand the accounting better. But in layperson's terms, what this means is that the accounting is being done based on when money is flowing in and out of the organization. Now, this does not follow generally accepted accounting principles in the United States. And the reason for that is that a charity that's doing something unscrupulous could potentially time the financial transactions in a way to make the charity appear that it has more assets than it really has, or more revenue or lower expenses than it really has, based on the timing of when that cash is flowing out. Even if those expenses were already incurred, or it owes liabilities, it owes money to outside parties, that information wouldn't be reflected in the current financial period of the tax filings that you're looking at. And for that reason, it doesn't follow GAAP, generally accepted accounting principles, because it doesn't provide you with a complete financial picture of what's going on. Now, does this mean that the small charity is bad, or that they're violating a rule, or that they're intentionally misleading you? Absolutely not. Cash basis accounting, if you're not an accountant, is the easiest way to maintain your bookkeeping, and that's why very small charities do it that way. It doesn't necessarily mean that they're doing anything wrong. It just means that if you were a donor who isn't familiar with the charity or the people running it, and you were considering giving a larger donation, you might want to do a little more research before you do that, because there could be financial activities that are significant that aren't reflected in the current reporting year that you're looking at. Larger charities tend to follow an accrual basis of accounting, which provides a more complete picture of its financial activities, as well as its balance sheet, its assets, and its liabilities, what it owes to outside parties. Our website blog post explains more detail about this if you want it, if you can tolerate all of the accounting language, all of the accounting topics. A second way in which smaller charities differ from larger ones is that smaller charities tend not to have audited financial statements. There's a few reasons that this can be. First of all, audits are pretty expensive to have conducted. Even for a smaller charity, it can cost around $10,000, $8,000, $10,000, $15,000. So if you're a very small charity, having certified public accountants audit your books is incredibly expensive. Now, some charities, even if they're small, will have audited financial statements because of how and where they're soliciting donations. So charities that solicit donations nationally across the country are required to be filed in around 41 jurisdictions, states plus the District of Columbia, in order to be allowed to do that once they're a certain size. In some states, it doesn't matter if you're soliciting $5, you have to be registered. The rules vary from state to state, but around half of those states require audited financial statements to be submitted as part of those filings. So smaller charities that are conducting solicitation activities across the country may still have audited financial statements available. And on our blog post, we tell you where to look in the tax filing to see if they have an audit, and then some advice for where you might be able to obtain a copy of it. Because audits, because they're published by third-party public accountants and not the charity itself, which is what you see in the tax filing. When you look at tax forms 990, often those are published or filled out directly by the people at the charity. They may omit unflattering information. So getting a hold of an audit, if one exists, is pretty important to make sure that everything is above board. And the third way, a non-accounting way, that small charities differ from larger ones is economy of scale. So, here at Charity Watch, we recommend that our top rated charities, they spend, once we do our thorough analysis and make all of the adjustments that are necessary, which, often there are many adjustments we need to make to arrive at a program percentage for a charity. But once we do that, we generally recommend that top rated charities spend at least 75% of their cash budgets on programs and keep their fundraising down to no more than $25 to raise each $100 of cash support. Now, larger charities can do this because they have economy of scale. So they're not spending as much money, per unit of output. And we explain that more in the blog post. Smaller charities, they just incur expenses in a way that can make their overhead appear higher or be higher relative to their size. If you run across a small charity that's doing really, really important work, that's doing niche work that no one else in the community is doing, and they're providing very valuable services, they might have a lower program percentage than 75%. And as long as you feel pretty confident that the money, they're doing the best they can and that the money is really helping a lot of people or a particular cause in a substantial way, if the program percentage is a little lower than that, they still might be a charity worth supporting. They're not able to operate at a level of efficiency that a much larger charity can. And so you do need to keep that in mind. That 75% program percentage recommendation is really intended more for larger organizations, not teeny tiny small ones that might be doing really important work in your own community. That's enough for now. There's other differences that we get into on our website at CharityWatch.org. I hope that this information was helpful and that you visit our site for more information. Thanks, everyone.